Hi, uh, let's begin with first understanding about the financial management module structure, the scope. So once you understand the structure of the entire module, you will be able to clearly identify at which stage we are, what we are trying to learn, and why we are trying to learn. Okay, so financial management is typically broken down into three areas. One is borrowing or raising of funds. Number two, utilizing that funds to invest into assets or working capital and managing the funds. And then third is once you manage the funds and are able to make profits, then it's about distribution of the dividends. So these are the major three areas in which financial management is distributed: borrowing, investing, and distributing profits. And within borrowings, there are other concepts like what capital structure to be maintained so that the profits are maximized. What is the cost of capital that we are looking at? Once we know the cost of capital, then we are able to make the investing decisions. So all these are interlinked, and this is the structure. Above all of this, to understand all these three chapters, it is very essential for you to know the ratio analysis. So, ratio analysis comes above all of it. It is not part of any single domain, but it is helpful to learn all the three domains. So, for this session, our focus will be on ratio analysis. Okay, so what is ratio? What are ratios basically? So when we say ratios, it's nothing but comparison of one figure compared to another figure within the financial statements. Okay. It does not have any specific standards like in IFRS. There is a specific standards which says this is the particular way in which certain things are to be reported, right? But in ratios do not have any kind of standards. So it's just taking one number and comparing it with other to make some logical conclusions out of it so that you are able to make some decisions out of it. Okay, why do we need to understand the ratios? Why ratio analysis is important? Number one, ratio analysis is helpful in two ways. One is for internal comparison and external comparison. When it comes to internal comparison, it's the organization comparing its own performance with its past performance, comparing its own performance with its expected budgeted performance. So, as in today, you will sit to make budget for the next few years, or let's say next 3 months, and then 3 months have passed. How will you know that whether you have performed well or not? So, ratio analysis comes into play at that time as well. Then it also comes into play to compare departments within an organization. Which department is working better? Ratio analysis comes into play. Which subsidiary is performing better? Which geographical areas are performing better? And also, in certain companies, the compensation for top management is decided based on ratios. So that's how for the internal use ratios are beneficial. Number two, when it comes for investment decision making, like an investor is thinking of which companies to invest into, or the management of a company is trying to compare their own company with their competitors. So that's when external comparison comes into play. It's like comparison of one company with another company, or it could be comparison of one company with the entire industry average to either to make decisions or to make business investment decisions or business decision, anything it could be. So yes, ratio analysis is helpful for in many ways at many levels. Okay, what are the features of ratio analysis? So as I already said, there is no defined standards for ratios like we have IFRS. Okay, so you will see in real world when you start working, your managers at senior level or the directors, they have their own measures, they make their own ratios, They make modifications that you won't see this standard ratios everywhere. Okay, these are general ratios that we will learn. But once you understand the concept and logic behind those ratios, you will be able to modify them as per your needs and apply them in the financials. So for now, let's focus on the general ones for the exam purpose. And once you get a good hold on it, then you will be able to play with it along. Okay, so ratios cannot be blindly applied. Like, for example, we take two financial statements of two different companies. It's not like you'll take a ratio and put it in both the financials. No. Firstly, you'll have to see that are those financials made based on the similar accounting policies or not. Because if accounting policies are different, very different, then the ratios will not be comparable. For example, a basic example is if let's say if one accounting is based on accrual basis, one is based on cash basis. If you take ratios of both and compare, the decision which you will make out of it will be kind of nonsense, useless. Okay, so it cannot be applied blindly. It needs to have some mind application into it. Then ratios per se are not for decision making. Okay, ratios doesn't give you decisions. It only helps you to find the areas where you need to focus and analyze to make decisions. It's not like if you see some ratio, you see one ratio profitability 16%. Okay, very nice. Invest in it. No, it doesn't work like that. So you will take that ratio, you will compare it with other ratios, and then you will make some decisions. So ratios per se, just by looking at ratios, you will not be able to make decisions. By looking at ratios, you will know which areas to look into. Okay. Uh, that's what is mentioned in the next point. Ratios only highlight the areas to investigate, they're not the last verdict. And it ignores the size of the company. For let's say, if I take a small grocery store out here and the financial statements of that grocery store, and I plot the ratios. Ratios are in terms of either times or percentage form. Their unit of measurement is in times, percentage, or number, whatever it is. And if I take a one large MNC like Apple and I remove get ratios for Apple as well, and then I will be comparing these percentages and these ratios of these two companies. Looking at ratios, we will never know that what's the size difference of the company. So ratios don't consider the size of the company. So that's one demerit of the ratios. So again, ratios cannot be blindly applied. It has to be using your mind. Okay. So what's our objective in this session? Our objective is to learn the language of ratios. So every ratio means something. It tries to say you something. And as a master student, I think you should be able to learn the language of the ratios. Because once you do that, if you understand the language and the meaning of the ratios, you will not have a need to learn the formulas. No, you will be able to define the formulas and make your own ratios as well. So for this session, I will follow a pattern. The pattern will be I will take one ratio. I'll say what is the ratio about, why is it used, and how can we calculate it. If you know these three things, you will be able to apply those ratios in different scenarios. So ratios are classified into five categories: profitability, liquidity, financing, efficiency, and investment. We'll move one by one category to category. Before that, uh, understanding of the financial statement is very important. So far, we have learned it only from the accounting perspective, never from the financial manager's perspective. The way the financial managers look at the financial statements is different than the way a financial accountant looks at it. The objective of financial accountant is to make sure that the books of accounts are reported in a true and fair view as per the accounting standards. But the financial manager's view on the financials is to look at the finance within the financials and make decisions out of it. So the financials are slightly modified here. So I'll show you and we will go through it. Okay. I'll attach this Excel and this PPT in the video in the link below. You can download if required. Okay. So we'll go through this balance sheet. So generally, when we go through a balance sheet, right now you look it as in the financial accounting, you see it as a vertical format. But for financial management, I have presented it like this because it gives a better idea. And number two, in financial accounting, you see equity and liability here and assets here. I have changed the terminology slightly. I said this is sources of funds and this is application of funds. So you got the funds from here and you applied it here. Okay. So let's look at it as a story. Okay. So initially company is incorporated and equity shareholders infuse their funds as share capital. We take some funds from preference shareholders as well. Then we go to bank and we borrow funds from bank as well. Then we issue debentures and we borrow funds from debentures as well. So these are the amounts which we have borrowed from somewhere, either the shareholders or external lenders. Okay, using these funds, we invested some money in fixed assets. Then we invested some funds in investments. Then we went to creditors, bought inventory from them, and we sold them. We got debtors here, as in sales which are not collected yet, and we have some balances. And we got creditors here from whom we took the inventory and we have not paid them yet. And there are some expenses which are yet to be paid. Okay, so using these assets, we conducted our operations, business operations, and this is the profit and loss statement which we got. Okay, we made a sales here. To make the sales, we had to consume goods. Then cost of the goods which were sold is reduced and we get gross profit. From this gross profit, so what this gross profit means is the direct cost of the material which is sold is reduced. What remains is reduced from the sales. Let's say we get 100 rupees as sales, 100 euro as sales, out of which the direct cost of material which is sold is 60. So what remains is 40. That 40 can be utilized for other expenses. Okay. So those other expenses are bifurcated into operating expenses, non-operating expenses. Why? We will look at it later stage. Okay. So first we'll take operating expenses. And when we reduce those operating expenses from here, we get operating profit. This operating profit means everything that relates to the main operations of the business. Like if our business is to manufacture a product, then everything related to that product is covered here. After this, there is non-operating income and non-operating expense, which is like the investments which we have made here. We will get income on this. Or when we will sell this, we can either have profits or loss. So those are not our main business objectives, right? Our main business objective was to manufacture goods. So anything related to this is not for not non-operating profit or loss. That comes here. Okay. And then we get profit before tax. So far, what has happened is we used all these funds and we invested in these assets. All these assets were used to generate this revenue, to pay off the cost of goods sold, to pay off the operating expenses, and also to get this operating non-operating expenses and incomes. At this stage, all the expenses are paid. Then the first right to claim out of this comes for the long-term borrowings. So we pay interest on long-term borrowings at this stage. So once we pay, it's like we have paid your dues. So whatever amount is utilized for the remaining portion, you are not eligible to get anything out of it. So long-term borrowings are thrown out at this stage. When we pay them the interest, they are out of the picture. We don't have to take care of them after this stage for this year at least. Okay, that's when we get profit before tax. Then comes the government in play. Every country you have to pay taxes. So why interest is before tax? It's because interest is tax deductible. So the expense which we deduct from the profits, this is the reduced profit. We pay tax on this, which means we pay less tax because we paid interest. So interest is tax deductible, therefore it is before tax. When we have tax, then we have profit after tax. Once government is paid off, then the next right to claim the profit comes with the preference dividend. Okay. And once preference dividend is paid out, even they are thrown out of the picture. Now whatever remains belongs to the equity shareholders. And then comes a decision making of how much to distribute as dividend and how much to retain as profits for future investments, expansion of the business. So that's how we read the financials for financial management perspective. Now, why understanding this was important is you will know when we go through the ratios one by one, you will realize why knowing this is important, who is thrown out at which stage. Okay. So now that we have understood the story of the flow of finance within the company, now let's begin to understand the ratios one by one. This is just the snapshot of those financials I put here. I'll share Excel as well. Okay, so we'll start with profitability ratios first. And the first initial two are the very basic ones, kindergarten stuff. Gross profit. Okay, so gross profit ratio is nothing but the amount or percentage of amount which is left after the cost of the goods sold is removed from the sales. So when you get sales value of 100 and the cost of the goods that you have sold is 60, what remains is 40, that is gross profit. Why is it used? To understand how much percentage of the revenue remains for settling the operating expenses and other expenses. How much is remaining? And it's calculated just like school marks. If we in the school we get used to get, let's say, 20 marks out of 50 marks paper, we say 40 marks, 40% is the result. So that's the same formula used for gross profit as well. Gross profit upon sales into 100. Nothing rocket science here. Similarly, net profit ratio. So net profit ratio, again, since I said ratios do not have a specific standard, right? So when we say net profit ratio, some managers look at it as net profit before tax. Some look at it as net profit after tax. But most of people look at net profit before tax only. So for our course, we will look at it as net profit before tax. Okay, so net profit ratio. Net profit ratio is nothing but the percentage of sales that remains as net profit before tax after paying after paying off all cost of sales, after paying off all operating expenses, non-operating expenses, and interest as well. Okay, it is net profit before tax just after the interest, if you remember the structure of the profit and loss. Okay, why I've discussed how same net profit upon sales into 100. Nothing important here. Yeah. Then comes the return on capital employed. Now, this is important. This is important. It's calculated even in the industry worldwide. It is a very important ratio to understand. So, what is capital employed firstly? So, if we go back to the Excel again, and I said that company borrows funds from shareholders, preference, bank, and debentures. So, all of this together is called capital. This is internal capital, this is external capital, but it is capital. Equity capital, debt capital, but it is capital. So all of this put together is called capital employed. So formula is equity plus reserves plus long-term borrowings. This is one formula. Other formula could be total of all the assets minus the current liabilities. This current liabilities will again give you this number. So capital employed can be calculated in two ways, either add all of this or add all the assets and subtract current liabilities. That's how you reach at current capital employed. So the question is, using this all the capital employed, how much is the profit that you have made? What is the returns that you have earned? So remember this structure of profit and loss. Now you will understand the importance of this structure. Okay. At which stage all of these were involved? At this stage, just before throwing out the long term debt. At this stage, this profit belongs to all of them. All their money is used to generate this profit, right? Profit before interest and tax. So the formula what logically would be net profit before interest and tax divided by the capital employed. That's the return on capital employed. So yeah, so which profit on which claim belongs to all the capital providers, be it internal, external, be it debt or equity. And why is it used? To know the rate of return which is earned using all the funds of the capital provider. How to calculate? All capital providers divided by capital, which is profit before interest and tax, divided by capital employed into 100. Next comes return on ordinary shareholders fund. Okay, going back to the Excel. Now, when we say ordinary shareholders belongs to this equity shares and their retained earnings. These two are for the ordinary shareholders. This is for preference shares. These are the external borrowers. Now the question here is, what is the return on ordinary shareholders fund? So at which level of profits in the profit and loss statement belongs only to these guys? This is at this stage. Once we pay off the equity preference dividend, what remains is entirely for the shareholders, ordinary shareholders, right? So this is the profit earned out of this money. Okay. This was the profit earned using all the capital. This was the profit earned using preference and equity. This was the profit earned only using equity. Okay. So we take this profit of available for equity shareholders divided by equity capital into 100 is the return on shareholders fund. Done. Next. Okay, those were the ratios into profitability category. Now we are entering into liquidity ratios. When we say liquidity, liquidity means how liquid are the assets of the company. Is the company able to pay uh, their current liabilities, short-term liabilities, or even the long-term liabilities? How liquid is the financial position of the company? These ratios talk about that. So first one is current ratio. So current ratio talks about how many times when we compare the current assets means the assets which are supposed to be converted into cash within next 12 months. Okay, it turns over and over within the business. So current assets are the assets which are expected to be converted into cash within next 12 months. And the current liabilities are the liabilities which are expected to be paid off within next 12 months. So current assets talk about how large is your current assets against your current liabilities. How many times are you able to pay off the current liabilities considering your existing current assets? Like let's say if your current assets is 50 and your current liabilities is 20. So you can liquidate these current assets and pay liabilities 2.5 times 50 divided by 20. Okay. You can pay 20 once, 20 again, and you can pay 10 again. So you can pay 2.5 times. How did you get it? Current assets divided by current liabilities. How many times you can pay the current liabilities is the answer given by this ratio. Uh, Okay, so why is it used? It's used to see how safe it is for the company. Is the current liability not too huge against the current assets? If that happens, then in short term, company will not have money to pay the liabilities and they will start uh, suing the company for not paying their dues on time. Okay, so knowing current assets, current ratio of the company is important. How to calculate already discussed current assets on current liabilities. Then comes the quick ratio. The question comes in this current in the current ratio, we considered all the current assets, right? But it includes inventories. Now, liquidating inventory is not an easy task. It takes time. So it is not a very liquid. Like let's say if any of the liability becomes due and you have to pay it, it's not like you will take your goods and somehow sell it and liquidate the cash and pay the liability is not possible. So when we say about quick ratio, it talks about what are the assets which are really very, very liquid, which you can immediately use to pay the liabilities. So for that, within the current assets, we ignore current inventories and what remains is very liquid amount, and we use the same logic which we use for current assets, which is the quick assets which you have after inventory, quick current assets. How many times can you pay your liabilities using this remaining funds other than remaining current assets other than inventory? So formula will be same, current assets minus inventory divided by current liabilities. Then comes the cash cover. So when we say cash cover, the word cover, it will come many times in the ratio analysis. Okay, whenever you see the word cover, you have to imagine it like this. It's like a stone and a cover. How many times this cover can roll this over and over again? Okay, this is how you imagine. So you'll be able to make formulas out of it. Okay, so when we say cash cover, it means out of the cash profits which you make, out of the cash profits, okay, not the book profit has depreciation in it, which is not cash. Then there is loss on sale of machineries, assets, etc. Those are not cash expenses or cash losses, those are book losses. So ignoring all of that, if you remember the cash flow statement which we prepared in the previous semester, we had a portion for cash from operations in the cash flow statement. What it does is it take profit before the tax, then it adds back non-cash expenses and removes the effects which are not non-cash items, and also adjust the changes in inventories, the changes in debtors, changes in creditors, etc., with which you get the actual cash from the operations that you have made during the year. So we take that cash figure and we see, compare it with against the liability, and we see how many times your cash profits can cover your liabilities. Like let's say if you're making a profit of 100 and your liability is 20, it means you can pay these liabilities 5 times using the cash profit which you have. So again, the unit of this ratio is in times. Okay, the current assets was also in times, how many times it can pay off. Quick ratio was also in times, how many times it can pay off. Cash cover is also in terms of times, how many times it can pay off. The earlier ones, the gross profit was in percentage, net profit was in percentage, return on shareholders fund was also percentage, return on capital employed was also percentage, but liquidity is based on times. Yeah, so that was cash cover. How many times your cash profit can cover your liabilities, current liabilities. Next comes cash conversion cycle. So cash conversion cycle is nothing but the operating cycle in terms of days. The unit for this ratio is days. Okay. So what does this ratio talk about is once you buy your goods, from that processing it, making it to finished goods, then taking it to the market, selling it to the customers, then waiting for customers to give you money back. So initially when you started, you had cash, then you put it in the inventory, and then at the last stage you got your cash back. So the duration between these two periods is considered as operating cycle. Operating cycle means how many days did it take for your cash to turn over and over, your working capital to turn over and come back to the same position again. So, why do you need this? To know your working capital requirement. So, let's say if you calculate this and you get to know that your operating cycle is 60 days, which means your working capital will be stuck somewhere in different assets, current assets for 60 days. So you need to have that amount of working capital arranged beforehand so that your operations don't get stuck due to lack of capital. Okay. So knowing this operating cycle is very important. So how do you calculate it? Inventory days plus receivable days minus payable days. These days we will discuss in the next efficiency ratio. Okay. For now, just remember it. It is all the days that you take from holding the inventory, converting it to finished goods, selling it, waiting for the debtors to pay you. All that number of days, if you add up and then subtract the days that of credit that you get from your creditors, that's the net operating cycle days, which is also called as cash conversion days, cash conversion cycle. Then comes the quality of profit. So, quality of profit is similar to the previous ratio, that is cash cover ratio. Over there, we were looking at the operations, cash from operations paying off the current liabilities. At this place, what we are looking at is what is the quality of your profits. So in financial statements, the way in which you make profit and loss account, it does not consider the impact of non-cash items, as in that profit is after reducing the depreciation, and also the sales which you have shown at the top in the profit and loss account. Let's say here, okay, in the accounting profit, you see this is the profit because this is the sale and this is the purchase. But if you get into the detail, you will see that not all of this amount is realized by the, as in paid by the debtors to us, right? There are debtors standing here for 45,000. So in reality, uh, just to manipulate the books of accounts to get a certain amount of sales, what management generally do is in the end of the year, to meet certain targets, they book sale entries so that revenue targets are met, profit targets are met, but there is no collection from it. That amount is sitting in the balance sheet as debtors receivables, and in the next year, start of the period, they book it as a sales return. Okay. So for the first financial year, which was supposed to be manipulated, it is done. The work is done. So in that case, if person looks only at the profit and loss statement, they will see this is a good profit and loss statement, but they don't see here that it is not a real cash profit, it is just a book profit. So when we talk about quality of profits, they talk about in the cash flow statement, after adjusting those changes in inventory, changes in debtors, changes in payables, non-cash expenses, etc., the actual cash profit that you have generated, they compare it with this book profit and see what is the quality of your profit. So the formula for that is cash from operations divided by operating profit, which we see here, net operating profit. So the cash operating profit divided by books operating profit into 100. That gives you the quality of profits that you have. So higher the quality, higher the percentage, better is the quality, which means there is less scope of manipulation that you have performed in your books. Or not just manipulation, it could be genuine as well, that your collection period is too late, let's say. Then that ratio will tell you that the profits which you are actually seeing in the profit and loss statement is not the real one. The quality is not as good as it's supposed to be. That's the purpose of this ratio, quality of profits. Next comes the, sorry, free cash flow. Okay, free cash flow. So free cash flow is again we go back to the cash flow statement and we see the cash from operations part of it. And on the cash from operations part, whatever cash we have generated out of that operations, we set aside certain amount for future expansion. That is, we will have to install new machines or buy new machines, increase the capacity, etc. If there are some certain plans, if we remove that that amount out of there, then what remains is called the free cash flow. It can be utilized for other investments, new projects, it will then enter into the NPV kind of model, investment model, wherein to so first to for any company to make sure that they want to invest into another project, they want to start a project, they want to bid for a project, they have two options: either to borrow funds to invest in the new project or internal accrued cash flows to utilize in that project. So when we talk about that internal generated cash flows, where do we get it from? Here it is. So the operating cash flows that you've generated minus the existing projects planned capital expenditure. If you remove those, then what remains is the free cash flow. So the formula for this is cash from operations minus planned capex. Okay. Then comes efficiency ratio.